Hello and welcome to 5-Year Club video number 174, brought to you by this article that one of my friends posted on Facebook. The coming collapse, it is impossible for any doomed population to grasp how fragile the decayed financial, social, and political system is on the eve of the implosion. And that's really, true. If you think about 2008, nobody really understood how bad things were getting. Like a small number of people who became popular after the fact. But nobody really understood how bad 2008 was going to be when things were going well in 2005 and 2006, as they are going well now in 2018. And interesting kind of premise for the article. Little lead-in for that article. I'm not going to read this article. Part of the reason why is because there's a lot of political stuff. I'm going to read. I've already read the article myself. I'm not going to read it on this channel because there's a bunch of political stuff in here. The idea of collapse in general is kind of controversial. There's a lot of people who get press by saying the world is ending. Oh no, collapse, worry, fear. Pay attention to me because your brain is biased to worry about things instead of looking forward to good things in the future. And I don't want to do that. But I do think it's an interesting article, and I do think it's worth reading, so I'm going to link it in the description. And I want to investigate some of the financial ideas that are in this. This is kind of divided up into different aspects of a collapse. A lot of it is political stuff, talking about the architects of, the demise. But then, it also mentions all this will soon be compounded by financial collapse. Wall Street banks have been handed $16 trillion in bailouts and other subsidies by the Federal Reserve and Congress at nearly 0% interest since the 2008 financial collapse. And so I specifically want to get into kind of understanding more and investigating more about this financial aspect of it. And ultimately, I would like to get to a point where I look at historical financial collapses and events and kind of what strategies could you use to deal with that. And here's the tricky part, right? The tricky part is that this whole article is premised on the fact that it's impossible to really predict these terrible financial collapses. And so you would need a strategy that would do you pretty well in the case that there wasn't a collapse, and it would do you pretty well in the case that there was a collapse, and the timing of the collapse can't be a significant part of the strategy. So there you have it. But so a little bit more. I just want to do a little bit of meta around this article. One thing I always like doing, check out who the author is. Who the heck is Chris Hedges? Here's his Twitter account. Very compelling looking profile picture there. A Pulitzer Prize winning journalist, best-selling author and activist. All right, so Pulitzer Prize means he's good at English. I looked up his Wikipedia articles, so I'll cut it short. He went to Colgate and got a BA in English and literature or something, and then went to Harvard Divinity School and has indeed published a bunch of books. Currently teaches some classes at Princeton, or at least one class at Princeton. Lives in Princeton, New Jersey. So this guy is no random asshole. He has clearly significantly worked throughout his life, starting from a young age, to perform and do some solid research. I'm going to link that article in the description. You can go see it. The next thing I want to look at is this article references someone named Nomi. Let's go find Nomi. Nomi Prinz. All right. So this is the same paragraph we were looking at before. The steady increase in public debt, corporate debt, credit card debt, and student loan debt will ultimately lead, as Nomi Prinz writes, to a tipping point when money coming in to furnish that debt or available to borrow simply won't cover the interest payments. Then debt bubbles will pop, beginning with higher yielding bonds. So the way I read this, higher yielding bonds means riskier bonds. That's why they had to offer a higher yield. It kind of seems to follow that the riskiest bonds could be issued by companies that already have quite a bit of debt. And if those companies already have quite a bit of debt, that means they have interest payments on that debt to furnish. And if the people who are buying things from that company suddenly are not able to buy as much because the availability of credit dries up, then of course that company will not get as much revenue, won't be able to cover the interest payments on its debts. That will hurt its ability to continue servicing its debts, which will, if it defaults on the high interest bonds, of course, that it inevitably has, then those bonds are going to go bust, and that's no good. But tonight specifically, I wanted to look at Nomi Prinz. And so here she is. She is an American author, journalist, and public speaker who writes about Wall Street and the American economy. She worked as a managing director at Goldman Sachs for 2 years and as a senior managing director at Bear Stearns for 7 years, and was a senior strategist at Lehman Brothers and an analyst at the Chase Manhattan Bank. So she more or less got some degrees in math and statistics, and then worked on Wall Street for, I guess, a good, 10 years or so. And then she was like, F this, I'm just going to go write about Wall Street. So she started writing books. She wrote a book, All the President's Bankers, which analyzes the connection between the President of the United States, 19 presidents, and Wall Street, and several other books. She recently had a book come out in May 2018 called Collusion, that, is basically like how bankers rigged the system to screw everybody. And so yeah, that's her background. Point is, she is someone writing about Wall Street who worked on Wall Street for a decade, and that is a lot more qualification than most financial journalists have. So I think that she's worth some more investigation. Yeah, Collusion: How Central Bankers Rigged the World. All right, so we're going to visit her in a second. I want to go back here. These are things I have already read that mention people who believe in a coming financial collapse. All right, so this Michael Lewis book, Boomerang Travels in the New Third World, great book. I recommend anybody read it. It's pretty, it's been around for a while now. But this discusses people who are making large bets, actually, that a lot of the Western companies, the very indebted Western countries, such as France, such as Japan, will collapse. And their bets really depend upon Japan or France collapsing before the U.S. There is also this book, The Death of Money, The Coming Collapse of the International Monetary System. It discusses kind of like how the international monetary system works, and it discusses why the author thinks that you should put your money into gold and why gold will become kind of the world currency instead of the dollar. I think Rickards has been accused of publishing some kind of sensationalist. Yeah, good. Okay. Daily Reckoning. Gold speculator. Self-proclaimed expert in yeah. So look, he's the author of New York Times bestseller Currency Wars: The Making of the Next Global Crisis, published in 2011. The Death of Money: The Coming Collapse of the International Monetary System, published in 2014. The New Case for Gold, published in 2016, and The Road to Ruin: The Global Elite's Secret Plan for the Next Financial Crisis. So as you can see, James Rickards is very focused ever since 2011, publishing books on crisis. And this goes back to what I was saying in the beginning. There are people who make a living off of kind of marketing disaster. So I read that book, but I wanted to mention kind of his background because I think that must be weighted when considering the gold strategies in this book, which I don't think I really believe in. However, there's enough people talking right now and enough kind of signs that I think, it is worth continuing to pay attention to Coming financial instability. So this is the Naomi Prince book, right? Collusion. I might get this in audio form and read it. Anyhow, here is Naomi Prince's website, her blog, and she has this January 11th, 2018 article with her thoughts on 2018. So I just want to kind of skim through this with you and talk about some of the ideas here, and that'll kind of give us a sense of what was this author who was talking about some of the financial aspects behind this original article. What was this author thinking in the beginning of 2018? In last year's roadmap, I forecast that 2017 would end with gold prices up and the dollar index down, both of which happened. I underestimated the number of Fed hikes by one hike, but globally average short-term rates have remained around zero. That will be a core pattern throughout 2018. All right, I'm going to just kind of scroll past a little bit of this. I will paste this link in the article, so certainly you can read the whole thing in detail if you want. She is plugging her book. Great, okay. You know, got to make that money somehow. And here are the numbered themes. So number 1, central bank tightening and tapering, more talk than action. So she believes that the Fed will not raise rates as aggressively as they might, which would mean that that credit stays more available, because as you raise interest rates, then credit becomes more expensive, and when credit gets more expensive, of course, people cannot take as much of it. Another impact of raising rates slower would be that as credit stays available, that leaves more time for bubbles to grow. So financial bubbles, real estate bubbles, all kinds of things. As the availability of credit stays easy, then people can just continue taking on more and more debt and bidding up the prices of these assets with debt. Rising stock markets for now, but on shakier ground. So keep in mind, this was January 2018, so she doesn't have the benefit of kind of seeing that. I think 2018 for the stock market is about flat right now, and it's been a bit volatile. So as of now, for 2018, it was on shakier ground. There is definitely volatility. I'm not sure that she would have predicted Trump's crazy tariff bullshit, but yeah. But yeah, on shakier ground, rising stock markets, really to be seen. There's a lot of stuff that could change in the second half of 2018. Expanding debt and corporate defaults. This is something that we should certainly pay attention to. Debt is at epic levels any way you slice it. Public debt, corporate debt, credit card debt, student loan debt. There will be a tipping point. This is exactly the sentence mentioned in that first article. When money coming in to furnish that debt or available to borrow simply won't cover the interest payments. Then debt bubbles will pop, beginning with higher yielding bonds. Leverage is a patient enemy. That reminds me of the quote, like, the market can stay irrational longer than you can stay solvent. Fueled by low rates and a strong investor appetite, debt of non-financial companies in the U.S. has accelerated rapidly to $8.7 trillion, a figure equivalent to more than 45% of GDP. Non-financial corporate debt outstanding grew by $1 trillion over the past 2 years. U.S. tax cuts will propel more issuance at first due to the perception of more money available later, with which to repay it. That is not the same as actual profits. So her point is, people will project things forward with those tax cuts as if everything will go fine, but if we get into another recession and consumers aren't going to buy as much, then those projected profits are a bunch of bullshit. All right. Weakening dollar, rising gold and silver prices. Okay, so this would indicate that people are less confident in the U.S. government and scared, I think, because the only reason why you would buy gold and silver is because you are scared. Gold and silver do not have good long-term returns. Why? Because gold and silver are metals. They do not invent things. They do not create intellectual property or solve problems for humans. They're just shiny metal that people wear on their body to look like they're wealthy. So, yeah, I mean, it's amazing kind of that everyone loves it so much around the earth, which is the reason why it stays valuable and the reason why people kind of go to it as a safe haven when they're scared. But I don't recommend it because it is not a productive entity, which I think in the long run gets you ahead. Warren Buffett also does not like metals too much, just FYI. Ongoing economic power shift from the west to the east. Yeah, so as China and these other Southeast Asian countries develop more and more, they're going to become more powerful. And as the West suffers from its Social Security commitments and the baby boomers and the healthcare costs, then, and, you know, our demographic shift where we don't have as many young people as we need to be productive enough to pay for the old people that we have, we are going to sell our revenue generating assets, our stocks, to the east over the next 50 years. But, you know, this is talking about 2018. So I guess that's more of a long-term trend that I'm talking about, that I'm just kind of parroting back to you from this book that I read called The Future for Investors by Jeremy Siegel. Yeah. Okay, so the economic power shift from west to east and from the US dollar to the Chinese yen, will continue for economic and geopolitical reasons as China forges more solid global trade relationships and US retains its nationalist stance. So that's Trump fucking up our international trade. Given the Trump administration's isolationist and pro-bilateral trade agreement doctrine, China will augment its economic, military, and diplomatic presence globally. The Chinese government has invested billions in the BRICS. This is Brazil. Oh, come on. South Africa is the last one. China, I guess, is this one. India, I believe, is this one. And the R here is, come on, Lewis. Russia. Yeah, there we go. So Brazil, Russia, I think it's India, China, South Africa. So that is something for you to remember. That's what BRICS means. Development Bank and Asian regional organizations like ASEAN. That type of long-term groundwork will expand in 2018 as it did in 2017. Japan embarked upon greater cooperation with India and Russia to hedge its U.S. relationship. The Japanese economy also hit a growth streak in 2017. Its economy has been expanding since the start of 2016, the longest streak since 1999. All right, let's move on. Easy European Central Bank policy, ECB. Sterling rise into Brexit. In 2015, Mario Draghi, the head of the European Central Bank, decided to extend euro quantitative easing, I believe that is money printing, into March 2017. Then he extended euro quantitative easing to December 2017 with a promise to do more if necessary. There was taper talk in the ECB's QE program this year. In October, the ECB announced that starting in January 2018, its asset purchases will follow a monthly pace of $30 billion until the end of 2018 or beyond if necessary. Ultimately, on an absolute value basis, the move was camouflage that will lead to more quantitative easing for Europe, not less. All right. I think quantitative easing is a little bit more complicated than printing money. I think it involves like buying up certain types of assets. I'm not as clear on it as I should be, but my general impression is the more quantitative easing, the more inflation / money printing if all other things remain constant. Infrastructure focus. Currently, the U.S. federal government spends a modest $100 billion annually on infrastructure. States and cities have tapped out at $320 billion in allocated funding. How they could afford increases at more than double that rate is a mystery. Yet, the U.S. remains at a huge infrastructure disadvantage relative to Asia and Europe, Any official talk of a bill combined with associated news coverage alone would lift bidding interest for government contracts and share prices of companies in the sector. So maybe a bipartisan infrastructure bill? Guess we'll see if that happens. Wow, I'm getting tired. I gotta power through the rest of this video. Cryptomania grips more tightly. As for Bitcoin, despite its predisposition to being a Ponzi scheme, I agree, it should rise and sustain its high degree of volatility through 2018 for a few reasons. So she's a bull on Bitcoin. This is interesting. Hasn't done that so far. First, many funds have been green-lighted to get involved in the second half of 2018. So she believes in the second half of 2018 that, regulatory moves that allow more people to participate in cryptocurrency will cause it to go up. And ETFs are on the horizon, albeit with a plethora of surrounding problems and regulatory hesitations. Second, futures exchange activity will broaden the market. Third, establishment banks like Goldman Sachs have announced plans to set up crypto trading desks and promoted the possibility of Bitcoin becoming a legitimate global currency. All right, so we're going to move on from that, but that's an interesting idea. That's something worth looking into just out of curiosity, which is what things have been greenlit for the second half of 2018. I don't know. Number 9, going digital and green. Whether you use it, invest it, or are wary of it, one thing is certain: mining cryptocurrencies require substantial amounts of power. That's true. While Bitcoin's value was up 7-fold in 2017, its power requirements shot up by 43% just since October. Much of this power comes from generators fed by fossil fuel sources. That's not clean power. There are like big crypto mines in, I think, Mongolia, powered by coal. It's not good, but it's cheap. Green technology for uses in blockchain-related products will be a hot area in 2018, as will be clean and renewable sources of energy in general. All right. And then number 10, dangers of Trump's deregulation entourage. And I'm just going to switch to the bold part here because I think it's the most important part. Trump obviously is big on deregulation. A lot of the people he's appointed to manage government entities that would normally have some kind of like oversight or check on crappy business practices. Those people aren't interested in doing their jobs. Specifically with the Consumer Financial Protection Bureau, I don't know if I already read it to you, but there were articles recently about basically the boards from the academic world of the Consumer Financial Protection Bureau just being fired. And so they're being dismantled and they're not able to do their work. They're not able to do their job because the people who lead them don't want them to do their job. So that's a little bit of prologue for this last paragraph. The last time deregulation and protectionist businessmen filled the U.S. presidential cabinet was in the 1920s. That led to the crash of 1929, the Great Depression, ultimately brought us to World War II, as I explained in All the President's Bankers. So a little bit of book plug there. But yeah, World War II came from more or less Germany being super indebted from World War I, which finished around 1918. And then what happened is, like, throughout the 1920s, the European countries and the United States did not see any reason to release Germany from its debts. And when they didn't release Germany from its debts, the German government didn't feel that they had many options, and the German people didn't feel they had many options, which is one of the reasons why Hitler, as a radical, insane piece of shit, was allowed to come to power and was able to come to power. All right, so during the past decade, the helium that inflated asset bubbles and fortified the global banking system was central bank collusion. At some point, the financial dam is destined to break. It has to, and it will. So she is on the same page as Chris Hedges and on the same page as the people in Michael Lewis's book Boomerang, and on the same page as Chris Rickards. And by no means is this some kind of like statistical... this is all just a handful of people I'm talking about now. And certainly there must be some bias in that kind of like a book saying that everything was going to be okay is probably less popular than a book warning about a coming collapse. Um, Anyhow, at some point, it has to, and it will. On that sober note, I leave you with this quote from The Rich Boy, written in 1926 before the Great Depression by F. Scott Fitzgerald. The world, as a rule, does not live on beaches and in country clubs. Whoever we are and wherever we live, may we face the challenges of this year and our times with awareness, courage, and action. All right, so that's a nice little like 10 list of 10 things that this person predicts that lead to a lot of interesting research after that, if you are interested. It would be interesting, I think, if I went out and found kind of a survey of economists, of academic economists, or maybe academic economists and Wall Street economists. And if the survey said, like, what do you think the probability of a major financial collapse is within 1 year, 2 years, 5 years, 10 years, never. And just see what they say and compare that with what these books are saying. You know? The thing is, you run out of options. And I guess I'll close with one more thing. I was reading my book on world savings history, and it was talking about Japan. Specifically, it was talking about how World War II was financed by different countries. But I'm going to talk about Japan specifically. Japan, like some of the other countries, like Germany, did not think it could fund World War II using taxes. Because with the amount of money that it needed, if it simply raised taxes to get that money, it would really make people angry and pissed off, and they wouldn't stand for it. So instead, what they did is they issued war bonds. Well, it's not exactly war bonds. They had, I should put it a different way. Maybe they did issue war bonds, actually. Anyway, whether or not this is about Japan or Germany or the UK, all these countries did similar stuff. So the war bonds thing, that was the country's way of raising money. They said, hey, we have these bonds. You give us your money now. We'll pay interest on these bonds. And anybody who's able to give us money, just buy some of these bonds, and that's how we'll fund the war. So that, in addition to the taxes, they would also get, say, some rich people to buy the bonds. But it would be nice also if normal people could buy the bonds. However, normal people buying the bonds is not very efficient. Especially if you're selling these bonds in denominations that normal people can afford, $1, $50, $100, whatever it is, then you suddenly have to manage a lot more paperwork. You have to manage a lot more accounts, and that's a pain in the ass, and there's overhead. So you don't really want to do that. So instead, what they did is they would say, for example, in Japan, they would say, okay, we want everyone to save a lot of money. It's very important in the war to save a lot of money. It will help Japan to save a lot of money. Please save a lot of money. And they got more and more aggressive about it as the years went by. In fact, at one point in the war, they had kind of these mandatory community savings goals where if your family did not hit their required savings goal, right, to save money in, was it a postal savings system? I think it was. Then you wouldn't get your rations. So you think about it, you're like, wait, you just told me they weren't taxed. Yeah, technically they weren't taxed. It was a voluntary savings program that looks a hell of a lot like a tax. And all right, so now what happens? Well, people put their money into some kind of bank, whether it's a postal savings bank or in the case of Germany, were they state banks? I don't remember. Anyway, you put your money into a bank, and then what the government does is the government sells the bonds to the banks. So the banks are essentially aggregating all this money from the population and then buying these, large quantities of these government bonds, and that's how the war is funded. All right, so the war goes on, and okay, so what's the deal? What happens when you're losing the war? Well, when you're losing a war, things become more expensive, and they become harder to operate, and if, say the Allies cut off your source of oil, and your economic productivity goes down, then eventually the people in the country, they're not going to have more real productivity, more savings to save into those banks. And so the banks aren't going to be able to purchase any more of those bonds. And so if the banks can't purchase any more of those bonds with money they're getting from people, from real economic activity, then the government no longer has those bonds as a source of war funding. So what does the government do then? Well, as I was mentioning at the very beginning, they run out of options. So what they do then is they print money. And when they print money, you get hyperinflation, you get the prices of goods skyrocketing, and the prices of goods in this war situation are skyrocketing just as the population has already been bombed, has already been sacrificing throughout the war, has already been sticking all their money into savings. And guess what? Since that money is in savings and not invested, it's not hedged against inflation. So the inflation from printing the money to keep the war going actually steals money and is a direct tax on those savings that the people technically have in some account somewhere. So the people just get screwed. They get taxed by taxes. They are forced to save. And you know I encourage saving all the time, but a system where you save money because you won't get rations otherwise and you're not allowed to withdraw it, that's not much of a saving system, is it? I mean, that's savings in name only. And then finally, you're taxed by this inflation stuff. And in the coming collapse, the Death of the Dollar book, they talk about that the U.S. will just print money when in the next financial collapse, and then that will come with a lot of terrible problems. But again, you run out of options. You just run out of options. I think some people like to think that like there's some magical, fuzzy math you can do in economics, but the truth is there's just no free lunch. Eventually, even with these very complicated international systems, you run out of options, and eventually your only option is just to suffer for, 10 years, 15 years, until through enough time, the financial system and the culture works its way through paying some of this stuff back, resetting institutions, shutting things down that are inefficient, and just purging itself of the crap and irresponsibility that caused it in the first place. All right, that is it for 5-Year Club video number 174. I hope you enjoyed it. Hope you will pleasure yourselves with some of these wonderful links. And I also hope that I can squeeze a few more videos out of this article and these people, because they have some interesting ideas that I think are worth investigating. Have a fabulous evening.